Well, folks, do we have some strange stuff happening in the stock market right now? I have some things to show you in this video that, man, some of these indexes are not acting normal whatsoever. And I want to show you some very strange activity I saw in the market here today and kind of try to explain what's going on here and why it's so strange. We're going to talk about some different stocks today. We're going to talk about some opportunities I see in the stock market right now and that I think are going to become bigger opportunities along with a few other things in this video. I hope you guys enjoyed. As always, thank you every single person that subscribed to this channel. Also, just so you know, late last night, I put together about a half-hour workshop. It's absolutely free to check it out if you'd like to check it out. It basically just goes through the steps on if you're looking to scale your portfolio to $100,000 plus, like what are the 5 steps to get there. As somebody that achieved that over about a 4-year span, I just thought I would share that with folks who maybe you're less than $100,000 in portfolio, and so that might help you out. There'll be a pinned comment down there if you want access to that. Like I said, it's a free video. You can send it over to your email there. Okay. Alrighty, guys. First off, we got to start talking about what we talked about on Friday at the top of the video on Friday, right? Walgreens. It's moving its way up, okay? Moving on up in the world. We're up to 2 trending now at this point in time. On Friday's video, I think Walgreens was the number 20th position for trending and now up to number 2. And this is a dividend stock I personally own, okay? Look at it. It's above Elon Musk. It's above Kanye. Holy smokes, you're really moving on up in the world, Walgreens. But yeah, it's gotten more serious. Now Gavin Newsom is saying California won't be doing business with Walgreens or any other company that, his whole opinion there, okay? So Gavin Newsom, who is the governor of California, he's not happy with Walgreens whatsoever. Kim on Twitter says, I just called and canceled my Walgreens account. Told the lovely rep it was because the company's refusing to fill prescriptions for a legal thing that's used to kill babies. I'm just kidding. I'm just kidding. If I had prescriptions there, I would transfer them too. Join me. Let's get their attention. Okay. People are very, very, very upset at Walgreens at this point in time. Okay. And this is crazy. This is wild because guess what? There are 2 black women CEOs of all Fortune 500 companies. 2. And they're trying to get one of them fired. They're trying to get one of them fired right now. Because let's be honest, okay? If you're going to say we don't want to shop there, you're basically trying to get the CEO of the company fired. So here we are in a situation where we only got 2 black women CEOs in the whole Fortune 500, and they're trying to purposely get one of them fired because they don't agree with the decision that they made. Interesting, okay? This is interesting, and especially coming from that side. I mean, the equivalent of this would be if Republicans try to cancel, I don't know, Garth Brooks or Morgan Wallen or somebody like that. Like, what are we talking about here, man? Okay? You can't be doing this. This doesn't even make dang sense at this point in time. What are we doing here? But it goes to show you kind of the day and age we're living in now at this point in time with the cancel culture and the boycotts and this company made a decision I don't agree with. I'm never shopping there again. How dare they? How dare they? Oh my gosh, they said what? Oh boy, okay. What does Wall Street think about all this? Well, I pulled up a 5-day chart of Walgreens, and I mean, to be quite frank, it really hasn't done anything. Today, the stock was down 1.7%. So this is after the whole aftermath and, with the stock trending and all those sorts of things right at the top of trending on Twitter. And so it looks like to me that Wall Street really doesn't really care about this that much. And they're kind of like, whatever this little outrage is on Twitter, it doesn't really hold weight anymore now at this point in time, right? And the more I was thinking about it, I was like, dang, this is just some publicity for Walgreens. I've never heard Walgreens even talked about. I mean, this is like free advertising for them, okay? Everybody's like, getting all emotional about this. Some people are happy about it. Some people are mad about it. Oh boy, okay. It is what it is. But hey, nonetheless, it's a topic of conversation right now. And, to be quite frank and to be honest about this, right? I've had Republican friends over the years that were very upset with Nike. Now, why were they upset at Nike? I don't even remember, okay? I don't know if it had something to do with the Kaepernick stuff or their relationship with LeBron James, a lot of Republicans hate LeBron James. I don't know, okay? But all I know is I had Republican friends that got real upset with Nike and they said, I'm never buying Nike. I'm going to buy Under Armour. I'm not going to buy Nike for any of my kids and stuff like that, okay? And so, nonetheless, these things always go on out there, but I kind of just pulled up a 5-year Nike stock, and this doesn't even include dividends received from Nike over time. The stock's up 81% in the past 5 years. In this last 5 years, that's a win. That's a win. So despite, all those people that are like, I'm not buying Nike, I'm canceling, Nike, I'm going to burn my Nike, whatever, okay? At the end of the day, like, the stock still performed amazing, okay? And so in this whole situation, I think Wall Street's just kind of looking at it and kind of laughing. And it's like people get all crazy on Twitter, and then a few days go by, a few weeks go by, and no one even remembers why they were mad at whatever. Because then there's something new to get mad at. There's a new person to get mad at. There's a new company to get mad at. There's a new politician to get mad at. And the world moves on, and next thing you know, it's boycott this, it's cancel this. It's a day and age we're living in, folks. It's the day and age, okay? Now, time to start getting into some extremely strange stuff that's going on in this market. And I mean extremely strange. And some of these things I was just looking at today, and I was like, this doesn't even make sense. Like, why is this moving, and this isn't moving, and this is moving? And this goes to show you how strange of a stock market we're getting into at this point in time. And I think a big component of it is, like, people are having trouble figuring out where this market's going, where stocks are going. Are they going down? Are they going up? And what's kind of the next bullish or bearish kind of move we're making here, okay? So the first thing up here, check this out. I'm sure you guys see this strangeness here. Look at Apple stock here today. It was the best stock of big tech today, the best stock of big tech. Meanwhile, Tesla, was the worst stock of big tech here today, literally the worst. Very strange divergence there, extremely strange, and on an upside for Apple and a downside for Tesla. And another reason that's so strange is how it was performing for a long time is if it was a green day, you would see Tesla, huge green, leading big tech, and you would see Apple stock, the lagger of the bunch. Now, on a super red day for the market, you would see Apple go down the least, meanwhile Tesla would go down much more. But the bottom line was, S&P Dow were positive today. So being that those were positive, to then go ahead and see Apple doing so well. Now, from my understanding, there was an upgrade out there for Apple today. But nonetheless, regardless if there's upgrade, downgrade, whatever, very strange to see Apple outperforming all other big tech to the upside on the green side, and Tesla, basically performing the worst of big tech here today. Very strange activity. But that's just the start of it. This gets even more weird, okay? The Russell 2000 was down almost 1.5% today. Meanwhile, the NASDAQ was right around break even, the S&P 500 was rated around break even, and the Dow was right around break even. The Russell, to have this sort of underperformance is pretty shocking, to be quite frank. Pretty darn shocking to see that level of underperformance from the Russell. Very, very strange, okay? That's not normal. That's the furthest thing from normal. I mean, if you told me, if the only information you gave me was, hey dude, the Dow's up 40 points today, SP 500's up 0.07%, the NASDAQ's around break even, what do you think the Russell is? I'd say the Russell's probably around break even, or maybe up or down 0.2%, okay? A 1.5% deviation between that and these, like, that doesn't even make sense, okay? Extremely, extremely strange activity going on there in the indexes, and something that you just look at and it's like, what's going on there, okay? What are they planning here? Because that's not normal, okay? Now, I want to speak about some opportunities in the market, okay? This is a watch list I have, and it's very interesting because I'm starting to see a lot of dividend stocks open up as tremendous opportunities at this point. And I'll explain why they're starting to open up as opportunities here in just a moment. But just today, I was looking at some stocks. Hasbro was down big, which, by the way, Hasbro, it was a stock I was considering, but this company's probably too much of a mess for me to buy right now. So although it's a great dividend yield and they own a lot of great brands, I can't make a move on that one right now. It's too messy. Foot Locker down 2.4% today. Cheesecake Factory, another big dividend stock, down almost 2% here today, trading at a very cheap valuation on both of those particular companies. And a lot of these stocks are opening up. And the reason a lot of these dividend stocks are starting to open up as great buying opportunities, and likely could over the next, I'd call it 6 to 12 months, the reason is treasuries are yielding so high now at this point in time. So now there's not as much incentive for investors to buy many of these dividend stocks. Before, it was like if you wanted to get some sort of yield and have your money, throw you off some money, you were almost willing to pay almost anything for some of these dividend companies just to collect a 2%, 3% yield, because you couldn't. Treasuries were paying nothing, CDs were paying nothing, savings accounts were paying nothing. But now at this point in time, how a lot of people look at, a lot of investors, is they're like, why am I going to take a risk? How they see it is, why am I going to take a risk in a stock to pay me a 4% yield or a 5% dividend yield when I could basically get it risk-free from the government? And so that's the thought process that goes into it. And this is, as long as treasuries are up where they're at right now, and especially if they go any higher, this will continue to hurt dividend stocks for at least the next, in my opinion, 6 to 18 months. And it really depends on how long treasury yields are up here. And I don't know if that's another 6 months, 12 months, or 18 months, but I would say somewhere in there, minimum 6 months, longest time period, in my opinion, is probably 18 months. And so nonetheless, this is going to make a great opportunity for folks that have been looking to add to dividend stocks, which I'll be honest, dividend stocks had been a ripoff for a while in the market. There hadn't been really good opportunities out there. The dividend yields were really low. What the stocks were trading at on PE basis, on forward PE basis, were very high. And I was even, somebody in the prep stock group sent me a DM last night, and they were saying, hey, you need to take a look at J&J. They got a great dividend yield, obviously great business, great franchises in that company, right? And I was looking at J&J, Johnson & Johnson, less than a 15 forward PE on that company. And so you're starting to get a lot of these great historic dividend-paying cash flow companies that are starting to trade attractively. And I don't think this is ending. I think you're going to get an entire year basically here where you're going to be able to, if you want, load up on dividend stocks and have some incredible yields. And the great thing is, a lot of these companies will throw off great share appreciation over the coming years. It's not just going to be about those dividend yields. And the other great component of that is, and I'll dive into that a little deeper a little later on in this video, is a lot of these companies raise their dividends year after year. The great companies, they'll raise their dividend the next year and raise it again. And so whatever you're making on the shares you bought for a yield, let's say it's a 5% yield when you bought your shares. Well, as you own that over time, based upon the shares you bought, it's going to end up being a 5.5% yield, 6%, 7%, 8%, 9%, right? As long as the company keeps executing. I mean, think about the yield Warren Buffett's getting on his Coca-Cola shares he bought, decades and decades ago. I mean, my gosh, I wouldn't be surprised if the yield is 100% or over 100% now at this point in time, meaning he makes more in dividends in a year than basically what he paid for the shares. I wouldn't be surprised if it was something close to that. It's got to be astronomically high because Coca-Cola over the last many, many decades, every single year, raise a dividend. I don't know if Coca-Cola's ever not raised a dividend in a year for the last, 40, 50 years. That company's just a dividend beast, right? So think about that for a moment. And so it's a pretty exciting opportunity as an investor in the market to now see dividend stocks, which, if you know my strategy, GVD, right? GVD 1, 2, 3, growth, value, dividends, building out a great portfolio of growth stocks, value stocks, and dividend stocks. And I'm excited that we're going to likely continue to have a great opportunity to add to many of these dividend stocks over the rest of this year here. So that's very exciting to me. Now, this market's going to be very volatile this week, folks. So, get your helmets on, okay? Get your seatbelts on. It's going to be super volatile. And the reason being is Jerome Powell is going to Capitol Hill, okay? They're going to grill him. They're going to grill the man, okay? They're going to grill him across the board, okay? A lot of Dems are going to grill him they're going to ask him why he's trying to destroy the economy. He's raising rates so much. He's killing housing. He's potentially killing auto sales, right? He's going to potentially put a lot of people out of work as if these interest rates can, continue to be high, right? And on the other side, they might be more concerned with the potential that he's not raising aggressively enough and that inflation is potentially hurting consumers too much. So you could actually have both parties grilling for different reasons. And on one side, he might have to be more dovish, and on one side, he might have to be more hawkish. So it's a really, really strange situation I can tell you, Jerome Powell is going to be very well prepped for this, but I'm telling you, this is a near impossible task for him. Because I'm telling you, for some folks, he's going to have to be dovish, but for some other folks, he's going to have to be hawkish, and it's going to look like he's talking out of both sides of his mouth. It's going to be a weird situation. But ultimately, this could affect the market very negatively or positively, depending upon how dovish or hawkish he has to get. And this is going to be something the market's going to be looking at very closely for any signs that maybe the Fed's going to pivot soon, cut soon, pause soon, 25 basis points, 50 basis points, because I'm telling you, these politicians are going to grill him. They're going to put him in some really tough situations where they're going to catch him, okay? And it doesn't matter really how well he's prepped. They're going to catch him. They're going to put him into a situation where, they're grilling him this way, but then they catch him this other way. I'm just telling you, it's going to be a crazy situation, and it's going to be pretty wild for the market nonetheless. And so it's going to be a very volatile week out there for the markets with obviously that going on, okay? Now, I don't know if you guys saw this. New bipartisan Senate TickTok bill will be unveiled on Tuesday. And this obviously matters for Meta in a huge way, and we'll talk about this. I think it also matters for actually businesses and creators and to the economy. TikTok's gotten so big now at this point in time. And I've done some real, kind of more in-depth thinking of this, okay? TikTok's gotten so big that it actually helps out people and businesses in a pretty substantial way, right? You could say maybe it ruins people's attention spans and whatnot, and fair play, okay? I'm not going to argue that point. But what I will say is I've definitely seen people's lives change, either creators or businesses, because they use TikTok, and it helped their businesses rapidly, okay? I have a friend of mine who she took off on that platform, and she's at a crazy level now at this point in time because of TikTok. I have somebody else that used to be in the private stock group who has a soap in candle business who's been really successful on TikTok and has grown her business, and now she's buying warehouses. Now she's got several many different employees, and she's scaling her business. And really the reason she's scaling it is because of TikTok and a lot of the videos they were making with the soaps and whatnot that were going viral. And so at the end of the day, those are just a couple examples of people I know personally in real life, right? But I can tell you there's a lot more of those stories out there. And so if it was to get banned, it might actually potentially hurt business. And, sometimes these things that they do, it hurts business. No different than when Apple decided to do the whole privacy changes. That actually hurts the economy. I can tell you, the more targeted ads you can get to somebody, the more it helps the economy. The more companies have to spend and not sure what they're going to get and maybe don't get that ROI, the more it hurts companies and it hurts businesses. And if it hurts companies and it hurts businesses, it hurts employees, it hurts jobs, it hurts the whole system. It hurts profits, it hurts revenues, it hurts everything, okay? And so sometimes these things, although they look attractive on face value, there's other things that actually can hurt the economy because of that. And I think that's just something to kind of keep in mind there in regards to this, okay? And it's definitely something I've been thinking about a bit here, okay? Now, in regards to Meta, right? Obviously, if there was to be any ban on TikTok, obviously it would be a beneficial thing to Meta. No doubt about it, okay? No doubt about it, it would be beneficial. We'll see what happens with that. I'm still not so sure because I can tell you the United States usually likes to make moves that are beneficial to business and capitalism. And so that's why I'm not fully of the belief that TikTok's going to get banned. I think it's a possibility, but I'm not fully of the belief, mainly because of the business aspect. I think if it wasn't the fact that it helps out so many businesses and folks like that, I think it would already been banned, I'll be honest. But I think at the end of the day, the government usually makes decisions based upon money in capitalism at the end of the day. And so I think that's what will likely happen there. But when it comes to Meta, it's still trading cheap. Even after its big run it's had from $88 at the lows of what was at the beginning of October to now, 4 or 5 months later, being at $184, its stock's still dirt cheap. It's still dirt cheap. And so Meta continues to be a buy for, this entire year, regardless of kind of where the stock price goes in the short term. So that's kind of the beauty there with Meta stock in this whole situation, okay? Now, I want to show you this. This is a total returns by decade for the S&P 500. And I think there's a few important things. Now, first off, this is what the Fed's trying not to have happen. Okay, they don't want a situation like we had in the 70s where the S&P 500 had a total return of 76% and 59% of that basically came from dividends, okay? The market went almost nowhere in the 1970s because inflation was super high for almost the entire 70s. They had to keep interest rates high for almost the entire 70s. It was a messy decade, man, messy. Obviously, the 80s was great, 90s was great, 1950s was great, 40s was solid, 60s was okay, not great, it was okay. 2000s, they want to also avoid a situation like this, where obviously going into the 2000s, we were already in a bubble, and then when you exit, look at where the stock market was in 2009, when you were exiting that decade. It was a disaster. It was a disaster, right? Growing through the great financial crisis. So you entered the decade in a bubble, and you exited that decade in the biggest financial crisis we've had since the Great Depression. Think about that for a moment. What a horrible, and that's how you get a negative 9% total return for a decade. Enter the decade in a bubble and exit the decade in a great financial crisis. Oh my gosh, okay? And so that's what ended up obviously happening in that situation. But it also goes to show you the importance of dividends over that time period in terms of the total returns, okay? And this is why I always preach about GVD 1, 2, 3, right? Because you have to account for this, because there's going to be certain time periods where growth stocks aren't going up. And it can happen for a year. It can happen for many years. Do not forget, prior to me getting in Tesla stock, that stock price hadn't gone anywhere for 5 flippin' flapjacking years. 5 years. Despite them growing their revenues like insane during that time, and growing their vehicles, and growing their customers, and growing how many vehicles they were producing, and growing their brand over those 5 years, they made tremendous progress. The stock price didn't go anywhere for 5 years, man. And so this is something to keep in mind, and this is why in your portfolio it's great to have some of those dividend payers, because many times that's where you're going to get some phenomenal returns. Just people don't look at it like that. They're like, I paid $20 for a stock and it's still $20. And it's like, well, if it's a growth stock and it's 20 and it's 20, yeah, you got nothing off that if they never pay dividends. But if it's a dividend payer and you collected a yield every single year and they up that dividend year after year after year, you actually probably got some decent returns, and you could throw that into more shares of that same stock, or you can buy other stocks with it, okay? So this is very, very important. That the Fed doesn't want this. The Fed also doesn't want that for this decade, okay? That would be no bueno. Now, I want to show you 2 important things here. This is my dividends only account, right? An estimated annual income just this year alone is $5,679 in my dividend only account. That's money I get for just holding those stocks. I'm not doing anything, just holding those. But keep in mind, over the coming years, these companies are going to pay bigger and bigger and bigger dividends, and eventually it's going to be $7,000, $9,000, $10,000, $12,000, $15,000, right? And so the numbers compound and they get bigger and bigger and bigger. The other thing to keep in mind is, see this right here, SPAXX, here, Fidelity Government Money. Check this out, okay? This is for just holding cash in your Fidelity account, for instance, 4.2% now. Now, this is important because I talked to you guys earlier about treasuries yielding so much, and now talking to you about just having cash in your Fidelity account and what you get as a return on that. It's incredible, right? But the important thing to remember is people are making a bunch of money through CD accounts right now, can be even savings accounts, through treasuries, through just holding cash in general, right? And so people are very incentivized right now to basically just hold on to their money. Don't invest into real estate. Don't invest into stocks. Don't go spend it on a new flat screen TV. Just hold that money around. And so people are very incentivized by that. But I can tell you, once that ends, and once again, I don't know if that ends in 6 months, 12 months, 18 months, whenever that ends, people are going to have to put that money somewhere else. And guess where it's going to come flooding back to? It'll come flooding back to the stock market first and foremost, and then other places as well. Once those yields end up eventually getting destroyed, and however long that takes, we'll have to see. But nonetheless, whenever that does happen, the money has to go somewhere. So then it ends up funneling back to the stock market in the end. Hope you guys enjoyed today's video. As always, I appreciate everybody joining me. Also, check out that video I recorded last night. It's a 30-minute beast there, going into essentially if you're looking to scale your portfolio to 6 figures and beyond. That'll help you out tremendously. That'll be pinned comment for access to that. And have a great day.